So today we have an analysis of Starbucks. Recently, they had a change in CEO. The CEO of Chipotle is now taking over the CEO of Starbucks, and we've seen some significant stock activity over the past few weeks. So I know a lot of people are looking at this as a potential value stock and a potential dividend stock. So let's look under the hood. Let's do a fundamental analysis of Starbucks to find out if we believe this is a quality business that we should have on our watch list to potentially invest in. So first off, let's look at the stock price right now at $93.95. As you see, when there is news of the change in CEO, and also because of who the CEO was, the CEO of Chipotle, we see this significant increase as there's a lot of investors have a lot of confidence in the Chipotle CEO because of the successes that he's had as far as leading them through the E. coli scare and also through the pandemic and making them more of a mobile and delivery business and not just in a brick and mortar business. So they see that this could be a great thing for Starbucks. So you see this spike here over the past week. So looking at the revenues of Starbucks. We see 10 years ago, 2015, they were at 16 billion. They've increased all the way up to 36 billion right now. Notice that they've had pretty solid gain. You had one negative year here in 2021, but then you have a growth still happening, but much slower at 1.3%. So we see that they have solid trends, still kind of in the medium growth state as far as the last 10 years, not so much in the last 5 years. So that growth is starting to tail off, which is the reason for the decrease in stock price overall and ultimately a change in CEO as they're going to start looking for someone to bring in some new strategies. Looking at the efficiency of the company, the gross margins, we see 30% in 2015. That has deteriorated down to 24%. So we want companies to either maintain their margins or at least grow their margins. We see Starbucks, their margins are deteriorating. This is definitely going to be a focus of the new CEO to increase those margins and get those back to a healthy rates. But right now we see that they're on the downtrend. Same with profitability. You have 12.6%. spiked at 18.3 here, but down to 11.2. So it's going in the wrong direction. So gross margins are decreasing heavily, profitability decreasing slightly, but still on the downtrend, decreasing in the wrong way. So that's where we are with revenues, positive, but not the most positive when it comes to the margins. So now looking at the free cash flow. How much cash is the company bringing in through its operations and what's left over for reinvestment, debt, acquisitions, dividends, and share buybacks? So we want to look at this concept, or we want to look at this metric every time we look at a business. So we see we go from negative cash flow of 553 million all the way up to 3.8 billion looking at the last 12 months. So looking at the change year over year is very choppy. Plus 28%, minus 15, plus 275, minus 67, minus 96. So all over the place, kind of getting back on track starting in 2022, but then ultimately not growing it consistently as we see that they are down to 3.8 billion. So we want to see that we have consistent cash flow, but it's not the most consistent as far as growth. It's there, a few down years, but it's kind of choppy. So positive is there, but again, when companies fall into trouble, this is something that can happen when they start to mature and they kind of have to reorganize and refigure out their way and their path forward. This can happen, but Starbucks has been in this state for the past 10 years. So it's time for them to, again, new strategy, figure out how they're going to move forward. And again, I think they have the right person to do it, but we'll see how that turns out for them. So cash flow is kind of choppy, but it is there. The balance sheet. So I want to look at the debt to free cash flow. How much debt do you have? Compare that to the cash flow that you're earning so I can see how fast you can pay off that debt if you were to run into trouble. So we want companies to be within a 3 to 5 year time frame to be able to pay off their debt. 3 or better is amazing. 5 or better is pretty decent, especially if you have consistent cash flow. But anything over that, we want to be careful. And as we see, Their debt balance has grown significantly from 2 billion all the way to 21 billion in the current year. Free cash flow, we've already looked at that. It's kind of up and down. And as you see, the debt to free cash flow, 5.8 years, 8.1, 4.7, 195 is ridiculous. 3.4, again, all over the place. But we want to look at the 5-year average, their 5-year debt balance versus their 5-year cash flow generation, the average of that, and look at how quick can they pay off their debt based on what they've had on their balance sheet in their cash flow statement for the past 5 years. We see that they average to be able to pay off their debt in 6.9 years. I would consider that poor leverage. That's not a good position to be in. So this is not good as far as their balance sheet or leverage. Now, to take a closer look, because when I was looking at the weighted average cost of capital, some things were looking kind of weird. So I took a peek in their balance sheet. I want to point something out to you as we look deeper into their balance sheet. Now, right now, the yellow line, their equity, your stockholders' equity, that is your assets minus your liabilities. So pretty much the net worth of the business. So when we look at the stockholders' equity, I'm seeing they're in the negative for the past 5 years. So they've had negative net worth as a business, technically, for the past 5 years. So this is a company as large as Starbucks, is successful. Some companies can survive like that depending on their business model, but this is not something that you want to see, especially in a mature company. You want them to have a healthy and maintain a healthy balance sheet. But looking deeper into it, I see that they have these two significant line items of deferred revenue. We got 1.7 billion in deferred revenue and 6.1 billion in deferred revenue non-current. Now, when it comes to liabilities, deferred revenue is the best liability that you can have, in my opinion. And the reason is the definition of asset and liability, as far as an accounting perspective is concerned, an asset is something that gives you a future benefit, and a liability is something that gives you a future obligation. So if you are doing a concert and you're selling tickets, the concert is next week, but I buy a ticket today. You have the cash, but because you took that cash and you haven't earned the revenue by performing the concert, you are now obligated to me to perform that concert. Therefore, the cash you received does go to your cash balance, but it's also a liability because you have not earned that revenue. So therefore, you have a healthy liability on your balance sheet of deferred revenue because you received cash before earning it. So seeing that Starbucks has 1.7 billion and then 6.1 billion in deferred revenue, I'm thinking, oh, this negative equity balance isn't as bad as it looks at first glance or to the naked eye. Once you kind of look a little bit through the balance sheet, you see they have this $7.8 billion of cash that they received in advance. So this is great because for cash flow purposes, and some companies can use this and invest this money into bonds, get interest on that money that's sitting because they haven't had to fulfill their obligation yet. So this is a good thing to have as far as liabilities are concerned, but we still don't want this to be negative. So what I did is I kind of adjusted the equity for the deferred revenue. If I don't count the cash that they received in advance and look at their balance sheet and their equity from that standpoint, we see negative 192 million and a negative 785 million for the past 2 years. Still bad to have negative equity. However, this equity, these numbers are a whole lot better than these numbers here. So sometimes you have to get and look under the hood and kind of analyze what you're looking at, and sometimes adjust numbers just to see what the true state of the business is, because due to accounting rules, not everything is as straightforward as they could be. But understanding that, we see that their equity balance is still negative for the past 2 years, but not nearly as bad as it looks here. And for the 3 years preceding that, we see that if you were to adjust for the deferred revenues, they actually have positive equity, considering that they are receiving cash or a significant amount of cash before they're obligated to earn that money. So I believe that's a lot to do with their gift card balances, since many people carry their Starbucks gift cards and keep balances on there for a long time. I'm not sure what else is included in this number, especially this deferred non-current. It could be there's that many gift cards out, and they don't expect to be able to, or to have to serve those people, since people hold on to their gift cards for sometimes years. So maybe a portion of that, or maybe even all of that, is for deferred revenue. I'm not sure. I'm just kind of suspecting what that could be. It could be something there. I know for a fact I've kept a Starbucks gift card in my pocket for over a year, so I can understand that. But just wanted to point that out. They do have negative equity, technically negative net worth, largely due to cash that they've received in advance. So a lot of these liabilities are a positive aspect for the company. So let's look at the dividend now that we've looked at the balance sheet. Looking at the dividend, we see Starbucks is currently paying a 1.82% dividend. That's pretty solid. Dividends per share, 57 cents per quarter is coming out. They've grown it annually for 5 years, 11.67% per year. That's really solid dividend growth. As a fan of dividend growth investing, this is something I love to see. Most people, when they get raises at their job, they're only getting 3 to 5%. You're only getting a raise that's kind of keeping you with inflation. So it could be a merit raise, but it's almost like it's a cost of living adjustment. But you can invest in these companies and get dividend growth for free without working of 11% per year. So it's all about investing early enough and often enough and having enough money earning you money, not passively, to earn that dividend growth. So I love dividend investing. The payout ratio, again, Starbucks, I would consider them a mature company. So I would consider their payout ratio is probably going to be over 50%. And we see it's at 66.2%. Now, in the future, if you're looking to get into this stock right now, I would not expect the 11.67% dividend growth in the future. We've seen their revenues and cash flows and even balance sheet looking suspect a little bit. Things are a little bit choppy for them, and they got a new CEO because they need a new strategy. So with that, I would expect the dividend to stay where it is and probably grow at a much slower rate. So I would say 1 to 3% per year moving forward for the foreseeable future, as they probably initiate some cost savings objectives and improve the customer experience to kind of boost those revenues and get those margins looking healthier. So I don't expect this level of dividend growth in the future. I do expect some stock appreciation. Again, I think they have a really good CEO in place and things are going to turn around for them. And even before that, I thought things would still turn around for them. This is a big enough company with a strong enough brand where their brand can even buy them time as they figure out how to combat some of the challenges that they've had. So I've been positive on the stock for a while. I think I'm even more positive now because of that. But again, you got to look at the fundamentals and take the business for what it actually is, not for what we hope it is. So looking at that, don't expect a dividend increase this significant in the future. But overall, I think this is an appropriate dividend policy for this type of company and for where they're at. Shares outstanding. We want businesses to have so much cash flow that they're paying a dividend and even buying back their shares, which benefits the shareholder. So if a company has shares and they're using cash flow to buy it, if I take shares off the table, the remaining shares now own bigger pieces of the remaining business. So we always want companies we always like for companies to buy back shares. Some companies are not really in a position to do so, and that's okay, but we want them to have shares outstanding policy or a buyback policy that benefits us as shareholders. And as we see, as they've come into trouble, they have increased their shares significantly in the past few years. So we don't like that, but we understand that they would do that to bring in cash. As we saw some of those years, the cash flow wasn't as great as it was before. So this is understandable that they would buy back shares, sell shares to increase their share count and bring in cash to the business. So not necessarily what we like to see, but we do understand given their recent history. Now looking at the value generation of the business, we're looking at the return on invested capital and comparing that to the weighted average cost of capital. So what's that saying? Return on investment capital. You've heard the phrase that you have to spend money to make money. So when we're looking at the return on invested capital, we want to know how much money are you making off of the money that you're spending or the money that you have available to put into your business. So we look at operating profit and compare that to capital. And what are the sources of capital? Capital is cash that's going to come from debt or equity. It's going to come from taking out loans, or it's going to come from your profits from previous year that's in your equity balance, or as we saw, they are selling shares, so they're bringing in more equity dollars for the business. So looking at that, we see that Starbucks actually has a healthy return on invested capital of 15%. 12 to 15% is a general target that a lot of people like. So we see that Starbucks is above that, just above that at 14%. Looking at their cost of capital is how much it costs to get that money. How much does it cost to get that debt? So we're looking at the interest expense on the debt, and we're looking at the opportunity cost of what you could get from using that money if you were investing it in the stock market versus putting it into your business. So what's that opportunity cost? We look at that weighted cost and we see that it's only at 4.5%, which means they're creating value this past year at a rate of about 10.63%. I'm saying in front of the screen, sorry, 10.6. Industry average is much higher as far as the restaurant and hospitality industry, but they do have a higher cost of capital. So we see that the industry average, they're creating value at about 11%. Starbucks is lagging behind that right now at 10.6. So this is solid, but is below average in the industry. And we want the best companies when we're investing. We don't want to put money into businesses that are not beating their competition. So again, if you're investing in Starbucks at this moment, you are truly believing in the CEO to come in and take charge. So I would encourage you to look at Chipotle over the past 10 years and seeing their growth and seeing what the CEO has done there, and see if you really have faith in this management to come in and make changes that are necessary to get Starbucks back on board. So just quick looking at the valuation, the price to free cash flow. If I buy this stock, how much money am I spending to get $1 in free cash flow per year? So we're looking at 28 times free cash flow. That's where it's trading at. The market cap compared to the free cash flow this past year, 28 times. So is it worth handing over $28 to receive $1 in free cash flow? It all depends on how fast that $1 is growing. How fast does it need to grow for 28 to make sense? That's what you need to figure out and believe in the growth story of this business to justify paying 28 times free cash flow. Looking at the PEG ratio, the price to earnings to growth ratio, simply looking at the PE and comparing the PE ratio to the current growth estimates of the business. So the PE ratio of a company that's fairly priced will equal its growth rate. This is a traditional metric. I like it because it's really quick and I can look at it really fast and kind of get an assessment of where the valuation is at the time that I'm looking at it. So looking at analyst estimates on Yahoo Finance, I see that the next 5 years, they're expected to grow at 7.7%. Understandable for a mature business. However, they're trading at a PE of 26.3 right now. So that means they're trading 3 times the rate that they plan on growing, or the rate that they are estimated to grow for the next 5 years. So technically you want something to be closer to 1 to 1. You want this number to be closer to 1 for it to make sense, or for it to be considered fairly priced or fairly valued. So according to this metric, this business is overvalued by a lot. So again, looking at this, if you believe in this business, that means you believe in the story, you believe in the brand, you believe that they can make the changes, you believe in their customer loyalty, and you believe that maybe they are going to grow at a rate that's much higher than right now, 7.7%. The 7.7% was projected before the CEO change, so I'm sure this number will increase with analysts, but by how much? And when will he be able to come in and get that change, those changes started increasing the revenue, increasing the cash flow, and the profitability of the business? These are questions that you have to recognize are legit questions if you're choosing to buy this stock. These are questions that are not answered, but you have faith that this business will figure out, and hopefully in the near future. And if you are a long-term investor, then you just have faith in the long-term brand of the company. So totally understandable. So this is just a quick look at this company. I believe it's pretty quality business, or I should say, let me back that up. I think it's definitely a quality brand. Definitely has the loyalty and the brand quality, but that's going to have to carry them over as they're kind of bridging into this new strategies. I am positive on this stock. I'm not invested in it currently, but I think it's going to be positive for them moving forward. So we'll see. But just wanted to give you a quick analysis and give you some insight on the quality and the current state of the business and potentially where they're going in the future. So if you enjoyed this stock analysis, please consider following and hitting the like button, and also sharing this video with a fellow investor that needs to hear this information and needs to see a company broken down in this way. So let me know in the comments what businesses you would like for me to evaluate in the future, and I hope to see you in the next video.